Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management and IFG are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.
If you're nearing retirement or worried if what you've saved is going to last, then this is the podcast for you. Now let's join Cornerstone co-founder Jamie Avila for the Cornerstone Retirement Blueprint Podcast.
Welcome to the Cornerstone Retirement Podcast. My name is Jamie Avila, managing partner at Cornerstone Wealth Management. Welcome today for another wonderful show. As you know, we try to bring all the great professionals and people that we have in the industry to help our clients. And today we have a special treat. We have Philadelphia's own Christopher Pepper. Chris, welcome.
Thank you.
You know, Chris, we brought in just last year, as most of our clients know. We were having some issues with referring clients to local tax professionals. And one of the most common things that we would end up hearing from them, the feedback was, man, they're not accessible. They're not returning my phone call. And I'd have to take calls like that, Chris. And so we decided to go on a quest a couple years ago. And it took us about a year to finally find the OG Christopher Pepper. And we're glad we did, because Chris has been a great addition to the Cornerstone team. Before we kind of get into the tax stuff and all of that, let's talk a little bit about you. So this is kind of interesting. On our website, we have our kind of fun bios and the 10 things that maybe people don't know about Chris Pepper. So accounting not only brought you, a degree, but it also brought you a wife, right?
Yes.
Tell us a little bit about how that happened.
Yeah, originally from New York. So I met my wife at CW Post campus on Long Island. As president of Accounting Society and Beta Alpha Psi, we had to be there for tutoring, and every business major had to take accounting classes. So she came in for accounting help, and I was there.
Oh, man. So you helped her with her accounting
Yep.
and then slipped a ring on her finger, huh?
Well, a few years later, but
Wow, you dirty dog, Chris. Man, that's awesome. Well, and then you have how many kids?
we have 3, 2 boys and a girl.
Okay, good. Family man. I've always wanted to know, you lived in Philadelphia how long?
5 years before we moved to Vegas.
Okay, so about 5 years.
Yeah.
So what is your favorite Philly cheesesteak out there?
I don't want to upset my Philadelphians, but I like the South Street Philly steaks better. Gino, I'm not a big Geno's and Pat's fan. They
Is
use
it the
more of a
cheese? Is it
ribeye.
the cheese whiz? That
I
kind of
like
bothers
it.
you?
I like it chopped up. So Jim's, Ishkabibbles, Steaks on South, if they're still there. It's been a few years since I've been back there, but
right,
South
cool.
Street is where I go for my cheesesteaks.
Well, man, I haven't had one yet, but next time I get a chance to go to Philly, I definitely would be getting a chili feast cheesesteak. So that's cool. And then it looks like that you're a diehard Mets fan, huh?
Unfortunately.
So how'd you get away from the Yankees there? Seems like everybody's a Yankees fan in New York.
Born in the late 70s, so when I was growing up in the 80s, that was all Mets.
It was all Mets.
Yeah.
All right, well, good.
Doc Gooden, Dallas Strawberry, Mookie Wilson.
Well, awesome. Well, listen, I thought where we would start today on the podcast is talking a little bit about tax preparation and what that kind of process looks like from you.
Yes.
So maybe you can tell us a little bit about your philosophy when it comes to taxes and that process.
So a new client coming in or just looking over somebody's account, I like to get at least 2 years of their back statements, returns, to see what there really is in it. Things can fluctuate year to year, so if they just come in with the prior year and then I'm doing the current year, you don't always get every statement, and then notices and issues can arise from that, and it just shouldn't happen. So I like to get 2 years worth of statements at least, go back, see. It also lets me see how the old preparer, if they were switching preparers yearly, what I might need to expect and what I should look for. If there's an error, I could see it in both years and know that maybe I want to go back 3 years for amendments.
Gotcha.
And so I like that.
How often does that typically happen? Like, you do 10 tax returns. How often are you, when you go and look back 2-3 years, are you typically finding things that maybe were missed?
It can happen more than you would expect, even sometimes on people that kept doing the returns. One of the clients I took on last year, their preparer just left off K1 that they had prepared in their office also. So it can happen more often than you expect. I mean, you hope it doesn't, but it's a good catch. And
yeah. So when you're doing that, are you you got your magnifying glass out looking at that tax return and making sure that you don't miss anything?
Yes.
Yeah. Because like you said, sometimes that does happen,
yeah,
right?
it can. And so when I'm doing a return, sometimes even if it's a larger return, being the only one here doing tax, I like to leave it alone for a day, pick it up the next day, and give it another review before finalizing it and sending it off, just because you never know. You might miss it and catch the same error if you're looking at it right away.
That's interesting. And then we had talked earlier how you came from Philly to Las Vegas, I think in 2012?
2012, yes.
Oh, yeah, 2012. So when you came here, give our listeners and our clients a little background on what you were doing prior to coming over to Cornerstone Tax Advisory Group.
So before coming here, when I was back east, I was working for Markham LLP, which is a international top 10 size firm now. Then moved out here to get away from the winters. Got on at a small family office, but not small, about $4 billion in assets, and anywhere between 200 and 400 companies at a time run under the office.
Man, that had to be crazy, huh? So you were
always
responsible
something going on
for those 200 to 400 tax. So I assume that family office just had a ton of LLCs and different corporations and such.
C corps, S corps, partnerships, the private foundation, individual returns.
And that was one of the things that really, intrigued me with you, when we were interviewing, is that not only have you been doing tax returns for, mom and pop, but you have a lot of experience when it comes to business as well, which, we have a lot of business clients and there's a lot of people that have businesses and, they're not really maximizing some of the things that they could be doing from a tax perspective.
Yes.
And whether that's because they just don't know and they're doing their own return, or maybe the person preparing it just isn't as versed.
Yes.
And so that's kind of interesting. Did you have a team helping you with that, or
there was a couple bookkeepers, and then it was us. There was probably 6 workers in the office besides.
Okay. And what was your role in that?
I was the tax.
Okay. So you were preparing,
kind of like a partner, the owner of the partner, like a tax company. It was kind of like running a CPA firm.
Yeah. Okay. Well, cool. Well, awesome. Yeah. And so, for our clients that you have met with, we just started with you last year and brought you on board. And I know we've been able to do probably a couple hundred tax returns just this first year. What were some of the things that kind of stood out to you as you met with some of our clients?
Some of the biggest things that popped out was Schedule Cs that really need to be S corps or a partnership in a way. Just you don't get to take all your deductions as a Schedule C.
Gotcha.
You throw it onto an S corp, you can sometimes get a little bit more, or at least save money on self-employment tax.
Well, that's interesting. Yeah. So a person, instead of using that Schedule C, which is more of on an individual tax return, when they open up an S corp or a C corp, whatever LLC, wherever they go, it just entitles them to a little bit more deduction, right? So that kind of pond gets a little bit bigger.
Yeah.
Well, that's interesting. Okay, cool. Well, tell us a little bit, if somebody wants to come in to see you, what type of information are you looking for them to bring in besides their tax returns?
So if they think they're going to be moving forward with the return here, it would be nice to have the current year information so that either we can prepare it while there or set up another appointment to come over and review the return once it's complete, being a preference. I do returns with the client there plenty of times. Some people like to just drop it off. Some want to just have a phone call.
Okay.
They're all available.
Okay, good. So do you have some sort of sheet that you send out for people that are looking to put together kind of a packet that you'll need?
If I already have the last year return, I can make an organizer for them that'll list everything out. If I'm going off just a conversation, it's going to be the W-2s, 1099s, brokerage statements if you have a Schedule C, your expenses, rental income, expenses if you have rental homes.
That's awesome, yeah. What about withholding? Are you seeing a lot of clients having the appropriate withholding?
It changes a lot. When Trump did the tax code back in 2018, I started to notice a lot of people owing more, and it wasn't anything to do with more in taxes. It was to do with withholding changes with the way they changed the W-4. If you stay at your company for your life or 20 years, you typically don't change that yearly or look at it. As you age, you may get married, you have children, they may leave the house, people may pass, and you need to look at your withholding, maybe not yearly, but at least every few years to make sure it's going correctly. I've seen probably 30 or 40 clients this year alone that have been hit by a pretty big tax bill, and it was really just withholding. Some because a spouse passed, some because
that's
of a divorce.
Big one, right?
Yeah.
I mean, I don't think a lot of people understand this, but when you're married, you're entitled to a larger deduction, different brackets, and when one spouse passes away, a lot of times the single taxpayer now, their taxes are they're way higher than when they were married.
Yeah.
In fact, didn't you have somebody just come in recently that had a withholding issue?
Yeah, last week I had somebody whose husband passed away back in late 2020, and so they were married joint for that year, and the income didn't change all that much as a retired couple to being a single person. So she went from the 12 to the 24 bracket with just a slight drop of income from last year, but being single, that
really
hit her bad and almost a $10,000 tax bill.
Yeah, and so that's something to think about, whether you're single or whether in the future you may have a spouse that passes away at some point. A lot of people think, oh, well, my income might go down. Yeah, but your bracket goes up. So you could actually be in a situation where you're making less money now single and actually paying a higher tax bill.
And yes, if you didn't change the withholding, probably only 10% coming out.
Yeah. So now with that client coming in, because this is the first year you're doing their tax return, are you adjusting that? Or?
Yeah, I've reached out to all that I can directly to say we need to up it to at least 20, if not 24%.
That's interesting, folks. So listen to that and make sure that your appropriate withholding is being withheld. That way you don't end up with some tax bill that you're surprised to get at a later time. That's something that's pretty easy that you can fix. What about clients that, throughout the year, or if they just have questions, are you pretty accessible? Like how does that work?
So I'm accessible all year round. I feel that your tax prep fee should include access to me throughout the year if you have a question on taxes. There will be things that come up that would be additional, but I'm available by email and phone. Most of the clients have my cell phone already. Yeah. In just the 1 year, because it's just easier.
That's important because, sometimes when you need to talk to your tax planner, you need to talk to them right away.
Yeah.
And so that's nice to know. And I know that I've gotten a lot of compliments from our clients saying Chris is accessible, and when I have a question, he's right there to answer it. And so that's nice because I know even in the past, before I transitioned over to you, I'd call my guy, and I'd been with him 10 years, and I'd be lucky to probably get a call within 2-3 days. Yeah. And I think that's pretty typical, right?
Yes, it is. There can be some things that are actual emergencies, and we had a client recently. They have 2 businesses, and their personal return, purchasing a car and selling it, how it would affect their taxes, where they put it, what names to go under.
Interesting.
Dealing with insurance issues, they just didn't know.
Yeah.
So she was calling me quite a bit for it, and I was glad to be able to help her.
Great resource. Well, let's get into some of the fun stuff with the rest of the time. So how much can somebody earn before capital gains are taxable? And what I mean by that, for those of you listening, is if you have a rental home, if you have a stock portfolio, if you have a business that you're selling, all these generate capital gains. And so help our listeners understand that threshold that they want to stay below.
So there are 3 capital gain tax rates, while there are 6 tax brackets. Capital gains can be taxed at 0, 15, or 20%. If you're single, you can make $41,000 roughly before your capital gains are taxed at the 15% bracket. Then it goes up to about $400,000 where they hit the 20%. Where if you're ordinary income, that would be at the $41,000 as single would be 12%. No, it would be 22. Sorry. Yeah. And the $400,000 would be 37%. You can double the numbers for married couples, so it's at $83,000, and then not exactly double for the 20%, but you go to that at $517,000. And so if you can lower your income for a year and keep it under that $83,000, your capital gains could be taxed at a much better rate than what your regular income is.
Absolutely.
And save
So
a ton of money.
sometimes you got to be strategic,
Yeah.
right? And you got to find that tax year where you can have a little bit lower income threshold so that if you are selling that property or selling that stock, you're not going to pay more than you probably should.
Yeah.
And so that's interesting. What about I know I get a lot of questions, and I'm sure you do, from clients that are asking about Social Security.
Yes.
I get a lot of people saying, oh, well, my Social Security doesn't get taxed. That's just what they think.
That's unfortunately a common thought, and it doesn't if you make no other money virtually. If you can bring in less than $20,000, you're not going to be taxed on Social Security. But as a single, and this one is where a marriage penalty still comes into play. You don't see it in many parts of it. But if you're single and you earn between 24 and 35, your Social Security will be taxed about 50%.
Okay.
Is subject to tax, not tax.
So that means if I'm earning $20,000 a year in Social Security, only $10,000 of that will be taxable.
Well, additional income. So if you have, say, $20,000 of Social Security and a $20,000 IRA coming out or pension, then your Social Security will be subject to some tax.
Gotcha.
But if you're married, it starts at 34 to 44. So it doesn't exactly double it for you. And then when you're above that 35 and 44,000, 85% of your Social Security is subject to tax.
So to really not have your Social Security taxed, you got to be below the poverty line.
Or have it all in deferred accounts that are tax-free, such as Roth and things, which
Sure.
is why the conversions have become so popular.
Sure.
So.
And then does it only get taxed at 50%, or is there a threshold there?
It goes up to 85% of it can be subject to tax.
Okay.
And it's taxed at your ordinary rate. So
Yeah, so folks, for some of you that might be thinking the same thing, well, I didn't know Social Security was taxable. Yeah, it is, and it's based on how much income you're making in that year. And it could be 50% is taxable of your Social Security. If you're very, very lucky, it's zero. Or it could be up to 85% of your Social Security check is taxable. But that's a good thing to learn and to know. What about write-offs for deductions? Like what can we still write off in 2022? Are there things that we should know?
So as just a basic individual, there's not much anymore you can write off. With Trump's tax code in 2018, where they bumped that standard deduction, it took the itemized deductions and kind of squeezed them out of most people. You still have your medical, but in excess of 7.5% of your AGI.
Right.
So if you're making $100,000, you need $7,501 to get $1 of medical deduction.
Oh, wow.
Taxes got capped at $10,000. So here in Nevada, that's not that big of a deal because we don't have state income tax. Our real estate taxes aren't too brutal. But our neighbors to California and then those on the East Coast, they pay double $10,000 in just real estate taxes and then have state income taxes that don't get written off. Mortgage interest is still deductible, but again, it needs to be under a $900,000 mortgage. Otherwise, it starts to get limited. That is talked about being lowered to $750 right now. And then you have charity. You can give away 60% of your AGI in cash. Goodwill, things like that, is capped at 30%. And so it's hard to get, for a married couple, get up to $25,000, $26,000 of itemized deductions nowadays.
Yeah.
They got rid of all the unreimbursed expenses, tax prep fees, union dues, mileage if it's not reimbursed. They took all that away.
And so I noticed some of our clients have little side businesses.
Yes.
And they're opening up like S Corps or LLCs and doing some work there that entitles them to a little bit more of a deduction versus traditional?
The big one has been real estate. You've seen a lot of people pick up real estate over the last few years, especially out here in Nevada. Just such a hot market. There's plenty of inventory and people moving. So you'll see a lot of people there. And if you have that, you get to write off some of those things. If you're paying dues to Greater Las Vegas Realty and the MLS and things like that, you get to write that off. You get your business mileage, cell phone. If you're working out of your home, you have your home office. And if you're not itemizing, then you can take part of the things you can't take on the schedule anymore. A percentage, not all of it, but you could take, say, you got a 100 square foot room in your house and that's where you're working in an office. You'll be able to take some of the utilities and mortgage interest and HOA fees and things that you pay but don't get to write off anywhere else.
Yeah. And where do you see taxes kind of going? Where do you see our clients' tax bill going over the next 5 years?
So with no planning, it's clearly going to go up. There's no way with the way we've been spending money that it can't go up. But with the right planning, looking ahead, I do feel like we have the ability to try to minimize that on people. Yes, it's taken a big hit now, but it can. I mean, they're talking about, there's still the talk about getting rid of 1031s and step up in basis, or at least limiting what you can roll over as a 1031 in dollar values.
I saw that a lot last year. Fortunately, that didn't go through.
Yeah.
That would have hurt a lot of people. But yeah, 1031s, it seems like Biden has his target set on those. You said stepped up basis, which is important as well. So yeah, that old adage, you fail to plan, you plan to fail.
Yes.
And so we're always encouraging our clients to come in to see Chris in the off season to kind of really figure things out in preparation for the next tax season, to see what kind of moves you can make before you get that big sticker shock of that tax bill.
Yeah,
right?
Unfortunately, when you're coming in February, March, or April, there's not much we can do about the prior year.
Yeah.
So, I mean, we have maybe a little bit of an IRA contribution we can still make. That's all.
Yeah. So if some of you are listening right now and you're like, wow, I want to check out the last 2-3 years of my tax return to see if it was prepared right. Maybe you missed some deductions. Maybe you have money coming back. Chris offers free consultations. You can call our office, set up a time with him, and he'll go through that with you to find out if there's some missed opportunities that you missed out on the last 2-3 years, and to get you set up for future years so that you can stay ahead of the tax game. And so thank you, Chris, for being here, our guest. We appreciate you and all the service that you do within the community and with our clients.
Thank you.
And we look forward to having you on again. Talk to you soon.
Talk to you.
Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management and IFG are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.